Traders have their own language. They use words that might confuse a newbie or a non-trader. Trading lingo is a type of secret handshake that lets other traders know that you're a member of the club. There is a method to the madness of trading terminology. Many of these terms allow a trader to express in a concise thought in 1 or 2 quick syllables. In any direction involving trading, you'll often hear the terms long, short, and flat. In fact, every trader is always long, short, or flat. But what do these terms mean? Going long. When a trader says he's going long, he is placing a trade that will become profitable if the exchange rate rises. Selling short is when a trader says he is going short or selling short. He is placing a trade that will become profitable if the exchange rate falls. Flat, when a trader says he is flat, he is neither long nor short. This trader has no open positions in the market. Why do traders use these terms? Why not just use the word buy instead of long and the word sell instead of short? The answer is simple. When you consider that traders can make money whether the exchange rate moves up or down. For example, suppose you walk into my office and ask me what sort of trade I'll be making today. I'll tell you that I'm going to sell today. Isn't it true that the word sell could have 2 different meanings? Perhaps I'm going to sell a currency pair that I bought last week in order to take profit. Or it could mean that I'm opening a short trade. In other words, I'm selling a currency pair today in order to profit from an expected drop in the exchange rate. However, if you ask the same question of me and I answer I'm going short, there can be no confusion as to my meaning. If I'm selling short, I'm definitely going to make money if the exchange rate falls, and I'm definitely going to lose money if the exchange rate rises. There can be no doubt about it. Suppose you ask me what I'm planning to do today, and I tell you that I plan to buy. Again, this word has 2 potential meanings. Perhaps I'm going to buy because I think the exchange rate is going to rise, or it could be that I sold short last week and the exchange rate has fallen. In order to take profit and close the trade, I have to buy back the currency pair that I sold short last week. This is called covering a short. If I do cover my short position and I have no other open trades, I will be flat. I will have no open positions in the market. If I were to tell you I'm going long today, this can only have one meaning. It means that if the exchange rate rises, I'll make a profit, and if it falls, I'll lose money. The use of these terms removes ambiguity because they describe the trading activity in precise terms. Pip is a word that gets thrown around a lot, but what is a pip? A pip is the smallest increment of price in the Forex market. It is an acronym for the phrase percentage in point. For example, if we consider the US dollar Canadian dollar currency pair and say it is 1.10, we would expand it to 1.1000 for the sake of precise measurement. The reason why this is a more precise representation is that it allows us to show the smallest possible increment of change in the exchange rate. For example, suppose the currency rate rises from 1.1000 to 1.1001. We could say that the exchange rate rose by 1 pip, the smallest increment of change possible.